Something absolutely unprecedented is happening right now in global currency markets that Wall Street doesn't want you to see. The Federal Reserve just did something it hasn't done this century. And when you understand what it means, you'll realize why the next few weeks could determine whether you preserve your wealth or watch it evaporate. Here's what happened. Last Friday, the Japanese yen staged its biggest single-day surge since August, jumping nearly 2% against the dollar. But that's not the story. The story is why it happened. Traders reported that the Federal Reserve Bank of New York contacted major financial institutions asking about the yen's exchange rate. This is called a rate check, and it's the exact step taken before actual currency intervention. Let me be clear about what this means. The United States hasn't intervened in currency markets on its own initiative since the turn of the century. The last 3 times were helping stabilize markets after Japan's earthquake in 2011, supporting the euro in 2000, and buying yen back in 1998. That's 3 times in over 20 years. This is not normal. This is not routine. This is a signal. And Japan is listening. Prime Minister Sanae Takaichi warned of action against abnormal currency moves. Finance Minister Satsuki Katayama confirmed she and U.S. Treasury Secretary Scott Bessent share concerns over what she called the yen's recent one-sided depreciation. Translation: Japan and the United States are coordinating. When these two economic giants move together, markets don't just react, they convulse. I'm going to show you exactly what's about to happen, why it's different this time, and what you need to do right now to protect yourself and potentially profit. But first, you need to understand why this intervention is necessary, because it reveals the massive instability lurking beneath our markets. Japan has tried to defend its currency multiple times on its own in recent years. In 2024 alone, they spent close to $100 billion intervening in markets to prop up the yen. That's not a typo. Nearly $100 billion trying to stop currency speculators. In April and May of 2024, Japan spent over $60 billion in just 1 month. The yen would jump on the news, strengthen for a few days, then the effect would fade. They came back in July with another massive intervention, spending tens of billions more. Each time, the pattern repeated. Initial strength, then drift back to weakness. Why do solo interventions fail? Because the market is bigger than any single country. Currency traders know Japan has limited firepower. They can see the reserves. They can calculate how long Japan can keep selling dollars and buying yen before ammunition runs out. So speculators just wait it out, let Japan exhaust itself, then pile right back in, shorting the yen all over again. It's a game of chicken that solo Japan keeps losing. But when the United States joins Japan, everything changes. The market isn't fighting one central bank with finite resources anymore. It's fighting the Federal Reserve, which can create dollars out of thin air, combined with Japan's massive foreign exchange reserves. That's a fight speculators cannot win. History proves this works. In 1998, during the Asian financial crisis, Japan tried multiple solo interventions to strengthen the yen. They failed repeatedly. Then the United States stepped in with coordinated action, and the yen stabilized almost immediately. Markets got the message. Don't fight the Fed and the Bank of Japan together. But the most dramatic example is the Plaza Accord of 1985. 5 major economies agreed to coordinated intervention to weaken the dollar. The yen appreciated from around 240 to 120 over 2 years, the dollar losing nearly half its value. Gold rallied, commodities surged, non-US markets pumped higher. Investors who understood what was happening made fortunes. Now, some blame the Plaza Accord for Japan's lost decades, the bubble that burst in 1990. Whether that's fair or not, one thing is undeniable. Coordinated US-Japan intervention moves markets in ways solo action never can. So why is this happening now? What's forcing the United States to potentially intervene for the first time this century? The answer reveals multiple pressure points that are all coming to a head at the same time. From Japan's perspective, the weak yen has become political. When the yen weakens, imports become expensive. Food and energy prices spike. With elections in early February, politicians can't look weak on the yen. But raising rates carries risks. The Bank of Japan just raised rates to 0.75%, highest in 30 years. For an economy built on perpetually low rates, that's massive. Governor Ueda fears hiking too aggressively because rate hikes end economic expansions. Currency intervention offers a way to strengthen the yen without aggressive hikes. From the US side, President Trump wants a weaker dollar for exports. But there's another factor: interest rates. Treasury Secretary Bessent noted Japanese bond yields affect treasury markets. When the yen strengthens, US Treasury yields tend to fall. For an administration wanting lower borrowing costs, helping Japan strengthen the yen accomplishes that goal. The mechanics matter. If the Fed creates dollars and sells them for yen, that weakens the dollar and increases global liquidity. More liquidity means lower yields and higher asset prices. It's monetary easing by another name. But here's where it gets dangerous. This whole setup rests on a massive, hidden vulnerability that most investors don't even know exists. It's called the yen carry trade, and it could unwind in a way that makes August 2024 look like a warm-up. The yen carry trade is beautifully simple in concept. You borrow money in yen at near zero interest rates, convert it to dollars, and invest in higher-yielding US assets. You pocket the interest rate differential. As long as the yen stays weak or keeps weakening, you win twice. You collect the yield spread, and you benefit from favorable currency movements. It's essentially free money as long as the conditions hold. Hedge funds, banks, institutional investors, retail traders in Japan, known as Mrs. Watanabe, they've all been running this trade for years. Estimates suggest the total size of yen carry trades heading into 2024 was in the hundreds of billions of dollars. Some estimates go higher. It's become one of the most crowded, over-leveraged trades in global markets. When everyone is positioned the same way, the unwind becomes violent. Here's the problem. When the yen strengthens rapidly, the carry trade reverses violently. We saw this in August 2024. The Bank of Japan unexpectedly hiked rates by 15 basis points, more than markets anticipated. Within days, the yen surged roughly 6%. Carry traders who were leveraged, and most of them were using 2, 3, even 5 times leverage, faced immediate margin calls. They had to sell their US positions and buy back yen to cover their loans. There was no time to think, no time to strategize, just forced selling. What happened? Japan's Nikkei index crashed over 12% in a single day on August 5th, the worst drop since 1987's Black Monday. The topics fell similar amounts. The selling spread globally like wildfire. The S&P 500 fell 3%. The Nasdaq dropped over 13% in less than a month, as tech stocks, heavily funded by yen carry trades, got hammered. It was a mini crash, and it happened because of a relatively modest yen move, combined with forced unwinding of leveraged positions. Imagine what happens when the move is coordinated and much larger. Now imagine what happens if the United States and Japan coordinate a massive intervention. The yen doesn't just drift higher over weeks. It spikes violently in hours or days. Currency traders who are short yen, and positioning data shows there are record numbers of them betting against the yen, scramble to cover their positions all at once. Hedge funds hit stop losses simultaneously. Algorithmic trading systems trigger cascading sell orders. The whole thing feeds on itself in a reflexive loop. More selling triggers more yen strength, which triggers more margin calls, which forces more selling. But wait, it gets worse. Many investors don't even realize they're exposed to yen carry trades indirectly. If you own stocks and companies that have been buying back shares using cheap yen-denominated debt, you're exposed to a carry trade unwind. If you own funds that invest in emerging markets financed with yen borrowing, you're exposed. If you own real estate investment trusts that borrowed in yen to buy dollar assets, you're exposed. The leverage and interconnections run deep through the entire financial system, hidden in balance sheets and derivatives most people never see. This is why some analysts are warning that a coordinated intervention could trigger a significant market correction. Not because intervention itself crashes markets, but because it unwinds the leverage that's been accumulating over years of cheap yen funding. Think about it. If you've been borrowing at 0% in yen and investing at 5% in dollars, that's worked brilliantly for years. You've scaled up, you've added leverage, your returns have compounded. But the entire strategy depends on one critical assumption. The yen stays weak or weakens further. The moment that assumption breaks, the entire position reverses. And when highly leveraged positions reverse quickly, they don't unwind smoothly. They unwind catastrophically. The mechanics of the unwind matter. It's not just selling, it's forced selling at any price. When margin clerks call and say you need to close positions immediately or they'll liquidate you, you don't wait for a better price. You sell into whatever bid exists. That drives prices lower, which triggers more margin calls, which forces more selling. It becomes a vicious cycle that feeds on itself until the leverage is wrung out of the system. That's how flash crashes happen. That's how markets fall 20, 30, even 40% in days instead of months. So what should you do? This isn't financial advice, but here's a framework based on market history. First, diversification. If you're concentrated in big tech or banks, consider trimming positions. You don't have to sell everything, but locking in some gains makes sense. Second, defensive sectors. Utilities, healthcare, consumer staples hold up better during volatility. Third, consider gold and silver. History shows precious metals perform well when the dollar weakens. Dollar cost average rather than going all in. Fourth, if experienced and risk tolerant, tactical shorts on banks and big tech could work, but position sizing is critical. Fifth, keep cash or short-term treasuries. 20% in cash gives you options when others panic. And here's what most miss. If the yen strengthens and yields fall, long-term bonds could rally significantly. Being positioned before the move happens could generate substantial returns. The key, this isn't just about currencies. Coordinated intervention represents a fundamental shift in global liquidity. It's monetary policy by another mechanism. Winners recognize the change early. Losers keep fighting the last war. Rate checks don't always lead to intervention, but the coordination between the New York Fed and Japanese officials tells you they're serious. Even the threat changes behavior. Traders cover short positions. Allocators reduce leverage. The signal itself becomes intervention. For years, the trade was simple. Short yen, long risk assets. That worked while Japan kept rates near zero. But once Japan started hiking and the US considered the consequences, that foundation cracked. August 2024 was a warning. Now tensions are building again. You don't have to predict exact timing. Just recognize the setup and position accordingly. Diversify, hold defensive assets in cash, position for dollar weakness. Preserve capital during transitions, then benefit from the new regime. The setup we're seeing, coordinated US-Japan signals, massive carry trade exposure, political incentives aligning, doesn't come around often. Markets don't adjust smoothly. They reprice rapidly as leverage unwinds. You have time to prepare. Review your portfolio. Assess exposure. Make intelligent adjustments based on what's actually happening versus what most investors notice. The wealth you protect today could fund the opportunities that emerge when everyone else scrambles. There's another video you should watch next on how major monetary shifts create opportunities. Watch that next.